Welcome to our second quarter 2025 market update. The second quarter of 2025 showcased both the resilience of financial markets and their sensitivity to policy uncertainty. From the White House's tariff announcements in April to escalating tensions between Israel and Iran in June, investors faced many challenges. Yet, the stock market went on to stage one of the fastest rebounds in history and finished the quarter at new all-time highs. Overall, it was a strong quarter for stocks, while bonds also delivered positive outcomes. For long-term investors, these events are a reminder that while the headlines can drive short-term swings, maintaining perspective and staying focused on fundamental trends remains the key to achieving financial goals. Let's look at some of the key market and economic drivers for the second quarter. The S&P 500 and the NASDAQ both ended the quarter at record highs, gaining 10.6% and 17.7% over the 3 months, respectively. The Dow Jones Industrial Average rose 5% and finished the quarter just 2% below its record level. The Bloomberg U.S. Aggregate Bond Index gained 1.2% in the second quarter. The 10-year Treasury yield ended the quarter at 4.2% after reaching as high as 4.6% in May. Developed market international stocks rose 10.6% and emerging market stocks increased 11% in the quarter. Gold rallied to a new record level of $3,431 per ounce before settling at $3,308 per ounce to end the quarter. The US dollar index continued to fall over the quarter, ending at 96.88. It started the year at 108.49. At its June meeting, the Federal Reserve kept rates unchanged within its range of 4.25 to 4.5%. Despite significant volatility, the stock market recovered quickly once the worst-case scenarios for tariffs and geopolitical tensions did not materialize. The quarter began with heightened uncertainty following the announcement of new tariffs on April 2nd, which were more far-reaching than many investors had anticipated. However, as the administration engaged in negotiations and reached preliminary trade agreements with several partners, market sentiment improved. The Middle East conflict created a similar outcome, although markets were broadly resilient and went on to new highs after the ceasefire between Israel and Iran was announced. The equity market rebound was widespread, with many sectors, styles, and regions delivering positive outcomes. International stocks continue to lead the way in 2025, especially with the dollar weakening. Small cap stocks have lagged other parts of the market due to their greater sensitivity to tariffs and domestic trends, and the Russell 2000 index is still down 2.5% this year. At a sector level within the S&P 500, information technology stocks experienced a strong recovery and continued toward the new market highs. Many other sectors are supporting the market too, including industrials, which are now up 11.4% on the year, communications, which have gained 10.2%, and financials up 7.5%. On the other end, healthcare and energy saw weakness. Bond markets are also quietly contributing to portfolio outcomes, with relatively strong yields and falling credit spreads contributing in the quarter. Treasury securities and corporate bonds also experienced volatility during the tariff-induced drawdown, although the quarter ended in positive territory. The US dollar weakened through the second quarter despite tariff pressures. While a weaker dollar can be negative for consumers, it can be positive for US businesses and exporters, since it becomes cheaper for those using foreign currencies to buy our goods. While the dollar has declined this year, and is near the low end of its range since 2022, its value is still high compared to the past decade. The US dollar weakened through the second quarter despite tariff pressures. When it comes to monetary policy, the Federal Reserve held interest rates steady at 4.25 to 4.5% throughout the quarter, reflecting a measured approach to monetary policy in an evolving economic environment. Fed Chair Jerome Powell emphasized the Fed's focus on price stability, even as other factors complicate the economic outlook. Specifically, the Fed's updated economic projections reveal the challenges policymakers face. Officials now expect inflation to reach 3% in 2025 before moderating closer to 2% by 2027, marking an upward revision from earlier forecasts. They also expect real GDP growth to slow this year to 1.4%, a downgrade from 1.7% projection in March. These adjustments reflect concerns that tariffs could spur inflation and slow growth. The conflict between Israel and Iran added another layer of complexity to an already challenging environment. Israeli strikes on Iranian nuclear facilities and military targets beginning June 13th created immediate concerns about regional stability and potential escalation. However, the two countries agreed to a ceasefire after 12 days of fighting. While the stock market has ended the quarter at new all-time highs, the decline and rebound was challenging for many investors. Fortunately, bonds helped to support balanced portfolios during the quarter. High-yield, corporate, and treasury bonds all provided balance and are positive year-to-date. Interest rates have remained higher than many had expected, and short-lived concerns in April about a flight from U.S. Treasury securities did not occur. Budget discussions in Washington have brought renewed attention to America's fiscal trajectory. The national debt now exceeds $36 trillion, or approximately $106,000 per American. According to the Congressional Budget Office, the latest budget proposal could add an estimated $3.3 trillion in deficits over the next decade. While the proposal includes spending reductions, these are outweighed by tax cuts and spending increases elsewhere. Moody's downgraded the U.S. credit rating in May, citing concerns about successive administration and congressional failings to address large annual fiscal deficits and growing interest cost. This echoes similar challenges raised during previous budget standoffs in 2011, 2013, and from 2018 to 2019. However, in each instance, agreements were eventually reached, markets stabilized, and economic growth resumed. For long-term investors, these fiscal debates underscore the importance of maintaining diversified portfolios that can weather various policy outcomes. While deficit levels deserve attention, history suggests that the U.S. economy's fundamental strengths and adaptability remain intact. Thank you for your trust in us. Contact me if you have any questions.